Two sources of uncertainty are pressing on markets at the same time, and traders are pulling back until the picture clears. US stock futures edged lower as Hezbollah rejected a ceasefire proposal, adding a fresh layer of geopolitical risk to a market already on edge. Futures tied to the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite all slipped in recent trading. The move was modest, but the message was clear. Investors are in wait-and-see mode. When conflict risk rises in the Middle East, markets follow a familiar script. Money tends to flow out of equities and into assets considered safer: US Treasury bonds, gold, and the dollar. Oil prices can also spike when stability near major energy-producing regions looks threatened. That matters because higher oil feeds directly into inflation, and inflation is already something the Federal Reserve is watching very carefully. The ceasefire rejection adds to that pressure. Hezbollah's refusal to stand down raises concern about a broader escalation, the kind that is hard to price and harder to ignore. But geopolitics is only half the story today. The other is data. A US jobs report is due, and it carries real weight for where interest rates are headed. The labor market has been one of the most closely followed economic indicators throughout this rate cycle. That is because strong job growth tends to support consumer spending, which can keep inflation elevated, and that gives the Federal Reserve reason to hold rates higher for longer. If payrolls come in stronger than expected, it likely pushes back the timeline for rate cuts. Higher rates for longer tend to compress stock valuations, particularly for growth-oriented companies. If the number comes in weaker, it could fuel hopes that the Fed will cut sooner. But a soft jobs report also signals the economy may be losing momentum, which is its own concern. Neither outcome is clean. That ambiguity is part of why futures are lower heading into the print. Markets have been navigating a difficult backdrop for weeks. Resilient economic data on one hand, persistent inflation and restrictive interest rates on the other. A significant surprise in the jobs report, in either direction, could move both equities and Treasury yields in a meaningful way. The combination of a live geopolitical flashpoint and a major economic data release in the same session is, as traders well know, a classic setup for caution. The typical response is to reduce exposure and wait for clearer signals. Watch the jobs number closely. The gap between a stronger than expected print and a weaker one could be the difference between markets pricing in rate cuts or ruling them out for the rest of the year. This briefing is brought to you by First Financial News, clear, daily coverage of the economy and markets at firstfinancialnews.com.